What's up, everyone? It's Caddy with Money Investing. So wanted to go over some really interesting data and charts and help you understand the game plan for the next few months to at least a few years. So hope you guys are doing great and are having a great day. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, including all the member benefits and private videos like the wheel strategy and the 4 trade ideas that I shared more recently with all the members as well. So link's going to be down below. There is a 16% annual discount that you can take advantage of before the end of this month. So now that the recession probabilities are rising pretty substantially, so the recession risk is increasing with stubborn inflation, there's many economists that now believe there is a 70 to 80% probability that the US enters a recession by the end of this year. And in fact, even the Federal Reserve themselves have mentioned that in the FOMC minutes, right? That's the Fed, that's the central bank, FOMC, Jerome Powell, and everybody else pretty much mentioned and talked about it in the March meeting. And that's included in their FOMC minutes that came out today. And they mentioned that given their assessment of the potential economic efforts of the recent banking sector developments, the staff projection at the time of March meeting, including a mild recession starting later this year. So there goes the soft landing scenario, right? We are expecting a landing, but there is going to be a potential recession that is going to have that collateral damage with respect to the economy. Now, when it comes to recession, they definitely do have a negative connotation around it because recession means high levels of unemployment, job losses. That means a lot of negative impact on the economy, right? Earnings are going down. Companies are not hiring anymore. There is, slowdown in economic activity. You're not saving enough. You're not investing enough. There's a lot of different things that happen during recessions that have a negative connotation around it. But I wanted to take a little bit of a different angle and show you some charts, show you some data, and really help you understand why there's only one thing that matters right now over the course of next 3 to 6 months, course of next several months here at the end of 2023. There's only one thing that really matters, which I'll go over later in the video. But this right here is going to be how do stocks actually perform around recessions, right? So we have before recessions, during recessions, and after recessions. So you'll notice that on average, stocks performed worse 1 year before a recession than during a recession. And in the 2 years following a recession, price returns were positive 82% of the times. Okay, so if you just know that statistic in itself, 82% of the times, 2 years after a recession, stocks are actually positive. They're higher. So if you take a look at 6 months before, for the most part, we are negative. There's only one instance where we are up 10%. This is back in 1980. And then 5% green in 1957, 8% green in 1990. But for the most part, the average return is about negative 2% with only a 45% probability that we are positive in the months leading up to a recession. 12 months before, once again, you'll notice that we are mostly negative. With 1980, 1981, we're slightly positive. In 2001, we're down 23%. And on average, 3% down with a positive return of about 45% only. So once again, very much in line with 6 months before. 6 months after, 12 months after, and 2 years after, every single probability is over 80%, right? Even as much as 91%. So 1 year after a recession starts, we are positive 91% of the times with an average gain of about 16%. So I've got some other charts to show you as well. So you'll notice the stock market tends to lose on average 1/3 of its value heading into a recession. So this is another different study, different analysis going back as far as 1937, 1938. And you'll notice that drawdowns have ranged from 14 to 57% with an average drop of 32% during a recession or heading into a recession, right? So you'll notice that S&P 500 trough to peak to trough decline on average was 32% with a median decline of 27% during a recession or heading into a recession right now, it says. So around recessions, that's pretty much the decline that we have witnessed for the market on average since 1937, 1938. This right here is a study from Schroders, which pretty much mentions the EPS decline for the earnings, right? The S&P 500 earnings and how much have they declined and did they bottom during the recession or not. So you'll notice that for most of the times, the EPS has not bottomed during a recession. So this again goes back to 1929, 1933. 72% decline in earnings did actually bottom when during the recession. 1937, 1938, very similar analysis, 33% down in earnings per share, and it did not bottom during the recession. But for the most part, what you'll notice is the average decline in earnings per share is 18%, right? 18% is the decline in EPS. Average decline excluding the Great Depression and the Great Financial Crisis, 8.4%. So that's obviously those were two very key events, because Great Financial Crisis, the Great Recession, because of the housing bubble, was pretty severe. The Great Depression, again, in the 1920s, 1930s, was pretty brutal, and that's really going to have an outsized decline, 72%, and during the Great Recession, 88%. So both of those were pretty dramatic. Now, I don't expect, or I don't think or believe that we are in any of those environments. Yes, there's credit tightening. There is lending activity that's going away. Deposit bases kind of evaporating right now. We are seeing consumers weakening with respect to the savings rate. The housing market's too hot. We've got unemployment still at pretty much 50-year lows, but it's now starting to tick higher as initial claims also increase. Jobless rates also increase with all these tech layoffs and all that stuff. I don't expect it to be that severe. But even if we go with the average decline of 18% in earnings, that's going to be enough to put S&P 500 in a little bit of a shaky ground. Because, if you've got earnings per share expectation of, let's say, 225, right? And you simply multiply this by, let's say, 82, because that's going to be 18% decline, you got $184 in earnings per share. And right now, 4,100 divided by 185, we're all of a sudden trading at 22 times price to earnings multiple. At 3,500, it's going to be closer to 19. At 3,200, it's going to be closer to 17, right? So those are going to be some levels to also pay attention to, because earnings per share do indeed decline for the most part. You'll notice that most of the times earnings per share has declined during recession. There's no doubt about it, right? And we already know that first quarter earnings are going to also be down. Now, this right here is just another that same chart, but in a different way. So 1 year later from the recession and 2 years later from the recession, we have seen very positive gains for the market, right? So on one hand, you've got in this video me talking about there is going to be potential recession in 2023 and the chances have increased. Earnings per share is going to come down and the markets are also going to reflect that earnings per share multiple, right? And then on the other hand, you've got the markets pushing higher 1 year, 2 year, 3 year later. So what is going to be that most important thing? So this is what I'm personally doing. And this is what I'm also, in my opinion, is the best approach to consider. And that is going to be the thing that matters most is cash. Cash during recessions is literally like gold. It is the most valuable thing because you can take advantage of so many deals out there, both in the stock market and in the real estate market. Recessions, the people who are bold enough to take advantage of recessions in their favor and actually buy quality assets are the ones that actually do a lot better once their recovery begins, right? Because again, the data suggests that 1 year, 2 year, 3 years later, after a recession, the markets are extremely good and very generous in the returns. Jeremy Siegel also mentioned today that he is expecting a very strong 2024 and 2025, but he is somewhat pessimistic or uncertain in the short term in 2023. That is very much in line with what we have also talked about in terms of the consolidation in the markets, sideways trading. We're not really seeing a very directional move, but instead there is a lot of uncertainty with respect to where the markets are headed in 2023. But over the long term, I'm still very much optimistic the markets are going to do well. So how can we take advantage of that? Well, very simple, right? You take advantage when you see the prices come down to your fair values. You see the prices, you find good deals, right? That's why right now my cash exposure has increased, and it's going to be increasing a little bit more because I am preparing myself for the opportunities that present themselves later down the road, right? It's whether it's 6 months down the road or 12 months down the road in the next 1 year. I am preparing myself for good opportunities both in the stock and the real estate market. There's absolutely no rush for anyone to be looking at forcing a trade or flowing with that sentiment and just keep on buying, but instead take a step back, be patient, and if you just understand how rare these events can be, how rare the market's going down 20 to 30% can be. This is what the pyramid of equity returns look like. It'll really help you visualize what you're really getting, right? When the market hits bottom here or comes down and there's a recession and earnings per share decline, and if you do see any lower prices for the market, how rare that event actually is, right? So this is a pyramid. Again, this is more of a statistic and analysis or a bell curve, and what you'll notice in markets on a year-to-date basis are mostly positive, and this is going back as far as, I believe, 1800s. Below is the chart, total returns going as far as 200 years, right? So we're going back in the 1800s, and what you'll notice is most of the times the markets are positive between 0 and 10%. 46 years, the markets were positive 0 and 10%. 40 years, the markets were positive 10 to 20%. 25 years, 20 to 30%. 17 years, 30 to 40%. So majority of the times markets are positive. That's why it is an uptrending chart, right? That's why the markets have just been pushing higher. But the few times you can see the markets are actually down between 10 and 50 years, it is extremely, extremely rare for the markets to be down that much. Only 17 years, markets are down between 10 and 20%. Only 6 years, 6 times in the last 200 years, the markets are down between 20 and 30% on a year-to-date basis. Just think about that for a second, right? 6 divided by 200, that's 0.0, that's actually 3%, right? Yeah, 3% of the times the markets in the last 200 years are down between 20 and 30%. So if we get that opportunity of markets being down 20 to 30%, how rare is that as an event on a year-to-date basis? That's extremely rare, is it not? And then 30 to 40% 2 years, right? And 1931 during the Great Depression, the markets were down 40 to 50% on a year-to-date basis. So I don't want this video to come across as being negative or very pessimistic or anything, because it's the exact opposite. What I'm really trying to get across in this video is that there will be opportunities in the market, and both in the stock market and the real estate market, to come. There is going to be opportunities. It's just about how we prepare for them. And what I'm personally doing is just raising cash, increasing my liquidity, increasing exposure to more hard assets so I can take advantage of those deals when the potential recession hits. I do expect a recession, and when that happens, I am going to be ready for those deals. So that's exactly what the goal for this video was. And again, 1 year, 2 years after the recession hits, we have seen the markets be very generous and with some positive returns. And this chart also does show us the long-term trajectory for the markets also remains very much on a solid footing. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Let me know your thoughts down in the comment section below. What are your thoughts? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. 16% annual discount available till the end of this month. As always, happy investing. I'll see you all in the next video.